Okay, so we'll get started. Welcome everybody to Arca's second installment of our webinars on valuing tokens. The first one I think was very well received. We got a lot of requests for getting a little more granular, which we're going to do today in a specific example within the DeFi world. So we call this how to value DeFi incentive tokens, and specific to bear markets, which, as we all know, we have been in for a few months now. So my name is Peter Hans. I'm a Chief Strategy Officer at Arca. I'm also joined today by our Director of Research, Katie Talati, and Alex Woodard, an analyst on our research team who does a great job in DeFi specifically. So before we get started, just have to read an extremely brief disclaimer that I will pull up. So commentary is not intended to be investment advice, investment research, or recommendation. Consult your investment professional for your own circumstances. So we will move on, and I am going to first kick it off to Katie to get into a little more of the high-level items, and then when we get into the granular details of these specific token, we'll transfer over to Alex. If you have questions, please use the Q&A tab within Zoom, and we will try to get to everything as much as possible. So thank you. Katie?
Awesome. Good morning, everyone. We're going to start kind of just walking, for those who aren't familiar, through what token incentives look like right now within DeFi and basically why they're problematic. So DeFi token incentives kind of started around DeFi summer. This was 2 years ago. When we first kind of saw yield farming emerge as kind of this innovation and this way to get tokens in the hand of as many users as possible. So while that I think did a lot in terms of growing the ecosystem and creating either more TVL, more users, more volumes, it hasn't necessarily translated into the metrics that we'd like to see during what we call, what we're considering a bear market. And that is really primarily earnings and just the sustainability of this growth. So you can kind of see here we have some nice charts to kind of illustrate our point. But you can see here like DeFi TVL has really taken off. Even with the recent market downturn, it is still massive hockey stick growth over previous years. And that was largely, like I said, due to the fact that these DeFi projects said, hey, we're going to create a token. It's going to be for our governance, and we're going to just distribute it to people who use the project. So, but kind of also in this chart down here, you can see it really has hurt earnings for a lot of these projects, since a lot of them are seeing that they're giving out far more in incentives than they're actually earning back. So we one example, maybe you guys are familiar with Aave. That's a lend borrow protocol. They've had so many incentives, but it really hasn't helped their earnings. They're the largest lend borrow platform. They have like over $6 billion in TVL, and their token trades at 250 times price to earnings. So just to give you an idea of kind of like the potentially negative effects that these token incentives can have, and what I guess the current kind of problem is here. So like we kind of said, what you end up happening is that the net profit margin for a lot of these projects is grossly negative. And what we consider net profit margin internally is protocol earnings, or basically earnings that are sent to the DAO minus token incentives or tokens leaving the DAO. So the performance of these tokens, and if we look at kind of like I show you the performance chart of these individual tokens, their performance is tied to these incentives. A lot of them, we'll see later the chart, they maybe start off fairly strong, but for the most part, as they release more tokens out there, human nature says if you get something for free, you're just going to sell it. If you buy something, you're more inclined to hang on to it. Because everybody's cost basis for the most part on a lot of these tokens is $0. They're willing to sell at whatever price. And that's kind of where we've gotten to, where we are at today with some of these token incentives. Peter, can you change the next slide? Oh, one more back, thanks. So yeah, so we think a lot of this problem stems from just the misalignment where DeFi protocols, their main goal with getting out their token has been to decentralize, which to date, because there isn't a very good definition, as we know, regulators aren't, haven't really given people in digital assets clear guidelines on how to issue tokens in a compliant manner. A lot of projects are kind of having to go with what has been, generally accepted principles by their legal, et cetera. And so for the most part, a lot of them kind of abide by the principle, well, if it's held by a lot of users, then it's considered decentralized because we don't own the majority of it. So for most protocols, not only are they trying to kind of stimulate growth by giving out all these tokens, they're also trying to be able to prove, hey, we're decentralized because so many wallets hold our tokens. Just to give you guys an idea, dYdX, which we're going to talk about today, has 24,000 wallets holding its token, which is actually really decentralized if you think about it for most projects. Usually you see a really big concentration of these projects, but they've actually done a good job of really distributing out the token to a large number of people with their incentive program. So for us, really, the way we feel about DeFi tokens and the incentive alignment is that, the products themselves within DeFi, there's clearly product market fit. There's clearly use. We see volumes, we see we're seeing traders, we're seeing active users, we're seeing TVL flow into the ecosystem. But overall, a lot of these tokens are really not accreting much value back to the holders of the tokens, the DAO, or the project. And so, at least from our perspective, we're really looking to see like an overhaul of the token models that are adopted by DeFi projects. All right, so that brings us to dYdX, which Alex is going to give you guys a really great walkthrough of as the leading derivatives decentralized exchange.
Great. Yeah, so great overview on what we're seeing in a lot of incentives from Katie. And I just really want to take you guys through how we're seeing it on an individual, how these incentives really impact a project on an individual basis. So using dYdX, which has some of the most probably aggressive token issuance in the market, we'll kind of walk through how that's impacting its core metrics and its valuation. So I'm sure a ton of you guys are familiar, but dYdX is the leading decentralized derivatives marketplace. And they're doing anywhere from $6 to $10 billion in volumes per week. And that's at the low end that we're currently seeing in this low volume environment. So for context, they're making up anywhere from 85 to 90, 92% of the entire market share. Yeah, so if you go ahead and move on to the next slide, Peter. So how dYdX's token works. So their token was issued in airdrop, so giving away tokens to any non-US users that had previously used the platform, and that happened last August. Since then, they have been incentivizing volume. So this is where it really differs from a lot of the other projects that are incentivizing being an LP in a pool, like mainly incentivizing liquidity. They're going straight to the point and incentivizing volumes and giving away tokens per month on a pro rata basis of your volume share on dYdX's platform. And that's really all the token is used for at the moment. Currently, it's a governance token. They've done 5 to 10 different governance proposals on a very small basis. The main one probably being a grants program, and up until this week, not touching the tokenomics at all. And so like pretty fairly criticized, like there's not a lot of value flow to token holders, and it's heavily inflationary, and that's in a down market, that's really going to be felt here. As you can see, it's gone from 25 to $1.50 over the last 6 months, 8 months. And additionally, dYdX Trading Inc., the parent company behind the lab studios that built out the protocol, is still receiving all revenues. So dYdX charged 7.5 bips, and all of that is still flowing to the dYdX Trading Inc. and not token holders. Getting on to the next slide. So how are these token incentives really impacting key business metrics? So as you can see, I mentioned last slide that the token came out in August of 2021, and you can really see how impactful in terms of volumes this has been. Similarly, on an average revenue per user basis, this is completely hockey sticked up to the amount of money they're able to gain on a per user basis. And this is really because of an arb trade that each user is doing that a lot of large users are doing on dYdX. So for instance, they can have both a long and a short on dYdX in large size, making up a decent portion of the volume. And all they're doing is paying funding and they're receiving tokens. And so there's a net profit and a net incentive to do that until dYdX hits a certain price. So yeah, like as I mentioned before, it's just been really both exciting growth, but very, very incentivized growth from dYdX. Volumes have increased an insane amount and revenues have also increased an insane amount, but at the same time, it is in some ways unsustainable. Looking at the average revenue per user on a more same slide as before, Peter, on slide 9. Yeah, looking at average revenue per user against like Uniswap, probably another one of like the leading DeFi protocols, you can see just the massive difference in what they're able to gain because of that arb trade that each user is doing on the platform. And they don't have a ton of users. Uniswap is on average 75K weekly active users, as high as 350K last November. And dYdX has really been steady around that 3,000 to 5,000 users per week range. But probably most importantly here is this last line, the net margin that Katie explained below. So back in Q3, when their volumes were their highest, their token price was also highest, and incentives have stayed flat. So they were actually at a net negative margin in terms of cash flows going in and out of the DAO. Or what would be the DAO. In this case, it was dYdX Trading Inc. But they were incentivizing much more than what they were gaining. And that was really prevalent until dYdX's token price has come down. So finding fair value for dYdX. Recently, there's been 2 major updates in this tokenomics that we find incredibly interesting in terms of more sustainability out of dYdX. So the first one is they announced a V4 at the beginning of the year, but they announced recently that V4 version of dYdX will become a Cosmos app chain. This means that 100% of revenues will, instead of flow to dYdX's Trading Inc., will flow to stakers who secure the network, essentially turning dYdX into a pass-through token that can be valued by its earnings. Additionally, dYdX this week announced that there was a governance proposal that passed that's going to be cutting 25% of the rewards. And we're really interested in seeing this because one, it will improve margins, cut sell pressure. But what we're really interested in seeing is the rate of change of volumes based on these changes in tokenomics. Like, how is that arbitrage trade that I explained earlier impacted by change of the rewards? And is dYdX still the leading market decentralized derivative platform even after those cuts? Because that'll really show how sustainable dYdX truly is when they do run out of incentives to distribute. And then moving on to the next slide, all of this, all of these changes, the move to stakers and revenues being passed through, really allow us to value dYdX on an earnings model. So here we have a variety of scenarios and a variety of price targets on a price to sales basis, on creating a weighted valuation. So we tend to be quite positive, but what I want to highlight here is the difference between the forward price to sales at the current market cap and the price at the current circulating supply and the price at the 1-year circulating supply, highlighted in blue on each of these bear, bull, and base cases. what's interesting here is you'll see such a big segment because so much tokens are coming to market over the next year from both the incentives program as well as release tokens to the team and investors. So to dive a little deeper into this valuation model, we used a weighted average valuation, capturing the much more mature DEX sector average price to sales, the less mature decentralized derivative average price to sales, and Osmosis's price to sales. We use that as a specific project because it is the only clear app chain on Cosmos right now. And we wanted to weight that in because there's an inherent L1 premium included when moving to an app chain that we believe. So overall, we have a very positive outlook on dYdX from price performance, as long as volumes continue to be maintained and as more rewards can be rolled off.
Perfect. Thank you, Alex and Katie. So, that concludes the presentation portion. We'll definitely move to Q&A here. And again, if you have questions, and we have a few, please post them in the Q&A section here. So one just quick, when you mentioned, Alex, the market share that dYdX has, that's of other decentralized platforms, not comparing centralized, or that's the total? I can't imagine that's the total derivatives market, right? Okay.
Yeah, it's just looking at the decentralized derivative market share.
Okay.
I think on back of the napkin, they're probably making up 3 to 5% of total derivatives. I couldn't imagine it'd be much more than that.
So centralized is still considerably larger.
It's
than
much larger.
Yeah,
and it's for a variety of reasons. One is anything on chain, anything decentralized is always going to be a lot slower. So it's hard to really have that institutional grade like flow through an exchange. They're hoping that moving to a Cosmos app chain, not on an L2 on ETH, will allow them to see a lot more throughput. And two, probably most importantly, is even though there is the arbitrage with the token, oftentimes if you are just a trader on dYdX, you're paying 7.5 bips versus the up to 4 bips, or as low as 3 to 4 bips on, say, an FTX or Binance. So it's still much cheaper to trade on a centralized exchange.
Sure. And then it's just about access and things like that. Yeah. So in terms of the, when you see the pass-through revenue go to either, I guess, the token holder or in certain cases liquidity provider, is that paid in dYdX or is it paid in USDC? And
that is really up to governance in this case. Currently, when it's all flowing to dYdX Trading Inc., it's going to be paid in USDC or whatever the base payment is taken as. And that's pretty similar to, say, a Uniswap, where the LP will receive the base pair of, say, like the ETH USDC pool. They'll receive those two tokens when they're an LP in that pool. So that's pretty similar to what's happening here. It'll be up to governance on whether they want to receive dYdX or some form of stable or ETH, or well, not ETH really, since it's gonna be on Cosmos now.
Yeah,
as their payment.
Is that for the token holder too, though, or just the liquidity provider?
That would be for stakers. So anyone is going to be able to be a staker in V4, and so that'll be for pretty much any token holder that chooses to.
What if you're a passive token? Or do you have to be a liquidity provider?
You don't have to be. If you're a passive token holder, you're just earning the token, but you won't receive any staking rewards.
Okay, so you'll receive the token as essentially the distribution.
Yeah, the incentives. Yeah.
Got it.
But if you were to be a staker in V4, you'd have to actively choose to receive those dividends as a staker, because you're making the active decision to help secure the network in that case.
Understood. And then how do you think about the I guess, the initial payments, the rewards, right? I mean, is essentially like a marketing cost, right? And they're basically spending considerably more on marketing than they're bringing in on revenue in the hopes of growing the community and creating a sticker user base. How do you look at whether it's dYdX specifically or, the DeFi industry in general? And I'd imagine there's a lot of hesitancy to turn off those rewards or even decrease them for fear of, a lot of movement of customers to some other platform. Like, is that have we seen a lot of that? Is that something that you look at as a big risk in the market, or is a good platform a good platform?
It's probably a mixture of the two. So the only clear example that I have, and Katie might have more, that I recall of a protocol turning off rewards fully is Uniswap after their initial 1 month token incentives program. Again, Uniswap, massive, like market leading project, and has that premium where it does not need to have reward. Users are still going to use it. Especially with their V3 update, it has the cheapest fee in terms of decentralized exchanges. And all the decentralized aggregators are going through Uniswap on a majority of the basis. So they'll still see the volume flow. I think this one is an interesting case. If you go back to slide 8, really, or you're not presenting, but that was our slide that had the absolute huge growth and then taper off in terms of volumes. Like 2 months in, dYdX went from doing a couple $100 million in terms of volumes to multiple, like tens of billions of dollars per month. It's whether that's sustainable on 4 to 5K users that is the real question that I'm looking to have answered as this 25% rewards roll off.
Sure. And Katie, I think you were about to say something earlier.
I mean, related to the earlier question about are fees taken in, would fees be taken in the dYdX token or in the base pair, such as USDC? I also did want to point out that interestingly, dYdX does not offer any futures products on its own token.
Sure. And, and I think we addressed a lot of this next question kind of in the actual presentation, but, when you talk about, part of the difference between, a token in essence, a cap table and say owning, equity is that, there's really 2 seats you can be in. You can be a customer of a business and own the token accordingly, either to use the business or get discounts or what have you, or you can be just purely a passive investor under the assumption that, there's real value here, and this is your way of getting exposure to that business without actually being a user of the business. So the question is basically like, if all these, primarily DeFi tokens are governance, why? What is the argument for owning them if there's no kind of like overt revenue share, like there is if you are a part of the actual platform or community? And maybe the answer is there isn't.
No, I think there definitely is. Moving to V4, there will be clear pass through for something like a dYdX. You just have to actively help with security on the network. That's relatively easy to do, and there's obviously companies that can stake for you and do the hard work, and you'll receive the reward. So I do think by making this step, it moves from a purely a governance token to an actual pass-through token, which is what is interesting to us in dYdX as well. I think it makes it so it's possible to value it. I think it is probably a much more sustainable business model as well in the long run. I just think there needs to be significantly more regulatory clarity in that front, and we'll see much more DeFi projects move in that direction.
Sure. I would also add for any of the existing governance tokens, it also depends on kind of the actual value of the underlying project. Just some of the examples this person used was Uni, Optimism, and Aave. With Uni and Aave, both of those command quite a bit of TVL, quite a bit of volume, quite a number of users. They're pretty important infrastructure pieces. So even though their tokens don't do anything today, a lot of the community understands the value in governance and having kind of some sort of say in what happens in those protocols. So for example, on Aave, it's pretty important if you have like a token that it is available to be deposited as collateral on Aave. And that it can also be borrowed. That really increases kind of the distribution, the liquidity, the usage of specific tokens. So if you are another token project and you want to get listed on Aave, a good way to do that is to, own some Aave tokens so you can have some sort of say in governance. And although this doesn't have like an easy way for us to, there's no, easy way for us to value this obviously nearly as well as with earnings that go to token holders. And obviously we prefer that, that model. That is kind of the value that those projects have today. Now, when you have projects that launch like Optimism and maybe they don't have as much of a community backing them and the project isn't quite as used as say a Uni or an Aave, it's a lot harder to convince people that there's value in the governance token. And that's why you see those particular governance token projects really underperform.
Yeah, and there's a question about measuring the solvency of the project, which I think is just kind of measuring the long-term sustainability of the project when the rewards or the ARB goes away, right? So is there any? How do you think about it's not like traditional equities, there's no management team to call or CEO, and there's no earnings calls. Like, how do you think about the long-term sustainability of a business model?
Yeah, I mean, the best, I think this for the most part will probably be done through governance, in which we'll see different developers ask for grants to continue to develop the platform. But again, like these are very expense light projects. Like expenses for the most part are either done with equity in terms of Uniswap Labs, in terms of dYdX Trading Inc. Those are equity-backed companies. Their expenses aren't really coming from the DAO. The expenses or the cost of goods sold is the way I like to think of them, is all the token incentives. So dYdX will still trade, it'll still work without the token incentives. It's just, is it going to continue to work at the same level of volumes and people are just going to continue to use it for a less of a return on this arb trade, or is it going to revert to 2020, 2021 level volumes? That's where I think is the most interesting as they roll off rewards. Is we'll get a sneak peek at that. We'll be able to see the rate of change in terms of volumes immediately from those. So I think that is really something interesting to watch in terms of dYdX. But in terms of solvency, I think like the project will continue to exist. Whether there's future development, whether there's continued tokens to release is yet to be seen.
Sure. Yeah. No. I mean, I think there is no catalyst. There's no Chapter 11, right? There's no delisting, right? There's 20,000 tokens out there, but there's also quickly approaching zero because there's no more user base or value mechanism to it. But yeah, point taken. There were a couple questions about, and this is of interest, I think for a lot of reasons. I think the major reason this question is of interest is because there is a lack of regulatory clarity of security versus how tokens in general are viewed, and the questions were surrounding like, does something like this increase the risk of dYdX being viewed as a security, and to handle a lot of regulatory aspects of this. Like the one thing I'll say is one, I mean, there's nothing, people invest in plenty of security. So if something is or isn't labeled as a security, that doesn't make it investable or uninvestable, right? The questions arise, when we've seen this recently with Coinbase, because you have, in essence, like if you do have unregistered exchanges, listing securities in the U.S., obviously that's a problem. Now, in terms of like the primary beneficiary of a token sale or like initial offering, which isn't going on here, there's also no one who like stands to economically benefit from the issuance or sale of the security. So that would, you know, in the eyes of you know, I don't want to speak for the SEC or certainly Gensler, but you know, in the eyes of how the rule is supposed to be written, like there is no you know, centralized beneficiary who's receiving this, and you know, and obviously decentralization is a bit of a scale, but you know, I would imagine that in the next 24 months or so, we will start to see in the US at least a lot more regulatory clarity around what constitutes a security and not a security, very specifically for digital assets, as well as how the different exchanges and custodians are going to be regulated, to the point where it doesn't really matter if something is a security or isn't a security. It'll just depend on, you know, what type of entities trade it, what type of entities custody the security. I don't know if there's anything more, you know, to look at, to, you know, look into dYdX specifically in terms of this change.
I think not dYdX specifically, but I think there's also the point, like you have to be sustainable as well, like to ship all your tokens out to be fully decentralized and get your tokens shared with as many people and get in the hands of as many people as possible. Like that's good to an extent, but like going through these margins, they're insane.
Yeah, absolutely. All right, bunch of questions to go through, and I'm trying to think of you get the kind of some sort of logical logical order here. So here, kind of a more nuanced question, but in terms of the you know, kind of the V4 switch, you know, talk about the potential of front running from decentralizing order matching, and if that's, you know, switch is big enough to hurt price in your eyes.
I don't think I can't really speak on the first part of like the highly technical stuff, but I don't think it will hurt price. I think moving to a cleaner model of passing through token value is significantly better. Whether this is a better version of the exchange on Cosmos versus Ethereum from a technical standpoint, I think I'll have to test it significantly before I have an opinion there.
Understood. Okay, perfect. And then, yeah, I mean, I guess, you know, in Katie, you talked about Aave a little bit earlier. You know, whether it's, you know, Uniswap or Aave or the market caps of some of these names that, you know, how do we think about valuation differentials, right? Because you can have wildly different, you know, price to revenue, price to sales. Some may or may not distribute that to token holders. So how do you, you know, as director of research, like how do you wrap your head around these major valuation discrepancies?
I think you kind of have to not just use the numbers, honestly, when you're looking at these projects in terms of like, oh, this is, you know, trading way above price to earnings. Like, why would this ever be considered a good investment? I try to kind of get my team to zoom out and look at the whole picture. So in the case of something like an Aave, like I think I mentioned before, it's a really important piece to the ecosystem. So it's not a project that's going to go away overnight by any means. And you know, for any token to be listed within Aave's ecosystem for lend borrow is really, you know, kind of important for that project. And to date, you know, Aave has massively grown in TVL. I believe it's the third largest project by TVL of any project. It's issued across multiple chains. And so to date, it's really been kind of that growth story that we talked about, that, you know, projects have been really focusing on growing their user base, growing their TVL, finding product market fit. They haven't been as focused on enhancing their earnings. You know, increasing their revenues are great, by the way, because the revenue is technically measured as what borrowers get or borrowers pay, but the actual earnings to the protocol are very, very, very tiny. So actually what they did just introduce something though, via governance proposal that passed yesterday, where they're going to have their own stablecoin that's going to be backed by a basket of cryptocurrencies. So we'll see how this plays out. This is definitely gonna be like a longer term project, but that should actually significantly increase their earnings because a lot more of the fees associated with this new stable coin is going to flow to the DAO versus their bread and butter lend borrow business. So, you know, for them, it's interesting to see that, like I said, they've to date just been this growth story. Like, you know, even though their market cap far outpaces their earnings, we kind of zoom out and say, well, they're not going to go away overnight. They're very important to the ecosystem. They're going to figure out some way to increase their earnings, and they're already doing that, as we've seen. It might take a year or two until we really see meaningful change where their earnings kind of match more of their valuation, but they're taking kind of steps in that direction. So that's kind of how we think about the valuation. Is we try to take in all pieces of information and ask, what is the value beyond just the earnings, the revenues to this project?
Mm-hmm. No, that, I mean, go ahead, Alex.
Sorry, I'd say also valuations within digital assets are much more of an art than a science, and much more of a trying to figure out what your assumptions are and what are the main drivers than getting a pure price outlook. Like, as Kate, I can't stress enough, this has been crypto has been a growth story for the past 3 years, much more than a valuation story. Anything that's seen significant growth has had a significant premium and seen significant returns. Mm-hmm. So yeah, I think it's much more of an art than a science.
Yeah, absolutely, and especially given you know, in more traditional markets, you know, largely have at least some consensus over, you know, what looks cheap, what looks expensive, and then, you know, whether or not it's a value trap, it could be up for debate. But you know, there's a lot there. So, you know, in terms of valuation, and I guess, you know, the modeling, you know, just talk about, you know, what inputs go into when you look at your 1 year, you know, kind of like forward market cap. Obviously, there's a lot of issuance assumed in there, and I would imagine some of it is more spelled out, and some of it is more, you know, to your point, art. So how do you calculate the 1 year forward market cap?
Yeah, so it's trying to find historical growth rates specifically within users, and then building out from like an average revenue per user model is typically to find protocol earnings and get a forward projection of that. But typically the way I like to go about earnings models within digital assets, it again, like I said, it's much more of an art than a science. You can build out DCFs, but it's really hard to find like a hurdle rate or a WACC in this space. That there's no real formula there that's set in stone. So you can give it like 30 to 20 to 30% discount rate, but there's no real math that goes behind that, and there's no real terminal value math that would go behind it within digital assets. So that's typically why I like to stick with either like a dividend discount model or a pure earnings model going forward. To building those out. Like I mentioned before, I like to start with user interactions and figure out what changes can be made or what changes will be made in terms of token issuance incentives to get an idea on what is going to change within like the user's actions. And going from there, then you can build out, say, volumes for any sort of decentralized derivative exchange DEX, and then or lend borrow actions in terms of any lending and borrowing platform.
Perfect. One question that came up recently that I thought was interesting, and I think is you know, indicative of kind of where we are in the cycle, but it was about, you know, it's like, is there any evidence that value, you know, I assume they mean like value investing basically works in this asset class over the long term. So one, like there is no long term in this asset class, and then two, like there's a very big difference between, you know, value investing as a style and coming up with a valuation of an asset, right? Because, you know, like every asset that you invest in should have some value. You should be able to equate some value to it. And then, you know, whether one determines that like, hey, I'm going to buy, you know, in traditional value investing, you know, you might buy whatever, like, you know, New York Times debt because it's crazy cheap, even though it's a dying industry, versus, you know, in digital assets, like nothing is a value investment, right? You're in this market because you think over the next 20 years, blockchain will permeate everything. So, if you do see something that happens to be cheap and has incredible growth, like great, but figuring out what a valuation of an asset is always a good thing. And then I would argue, like any other asset class, over the long term, and as the market matures more, right, value versus value will contribute to more and more of the equation in terms of how assets trade. Yeah, I don't know. I mean, I don't know. Have you guys might want to articulate that a little bit differently, but yeah, we're not. I mean, because Arca puts valuations on things, unlike most people, like, it doesn't necessarily, we're not, this isn't Graham and Dodd here. Like, this is, digital assets. We're focused on the growth, obviously.
Yeah, I think completely agree with that. It's definitely growth investing within digital assets.
I would also just note, for those of you that weren't on kind of the first version of this webinar, where we kind of broadly explained what valuation in digital assets looks like. And if you haven't watched it, I'm pretty sure we have the recording in our investor portal, Peter, I think. But it's really important to note that, as Alex said, valuation here is an art, not a science. And we are, at the end of the day, trying to apply valuation models for equities to digital assets, which are pseudo equities. And so we're really using it as a framework to guide our thinking and to guide how we think about the growth trajectory for these companies. And it's much less about, we are only investing based on these outputs, and if a token is trading above or below this, we're buying and selling. There's a lot of different inputs, like I said, and I think you need to consider kind of the full story of a project when you're making these investments and making these investment decisions. And even though we're focusing today on kind of how, you would model out a decentralized finance project, the model or the valuation framework is actually different depending on what type of asset that you're looking at, whether it's a layer 1 blockchain like Ethereum, whether it's a project like Bitcoin, whether you're looking at a Web3 type project like a Helium or Arweave. And we're going to be getting into, we got into kind of the high level on each of those in that other webinar, but I just want to explain that, this is a very kind of narrow area of valuation within digital assets.
Great, perfect. And then, off that same, kind of line of thinking, and I just typed an answer to this while Katie was speaking, but it was, we get this question a lot as well, in more kind of one-on-one conversations, but in terms of where a token might fall in terms of a claim, or like, why buy it when you can own the equity or debt. And then the thing we'll say is, like, in many of these cases, there is no equity on the cap table, right? All that exists, and the only way to represent an investment in an underlying business is the token, because it is 100% of the cap table. And in situations where there is equity in a company like FTX or Binance, and they also have a token, well, like, one, you might not be able to invest in FTX per se, because it's not public. I'm not aware of any publicly traded companies that have tokens outstanding yet. I think that will change once we have more clear regulation in the space. But in terms of your claim in a bankruptcy or something, it totally depends on how the token's structured. Like, if it's a governance token and it is a company with equity and it files for Chapter 11, like, I'd imagine you wouldn't have claim on much. But if it's there are also tokens that have, like, very overt ownership of a specific asset or something else that might be transferable to something else, and then your claim is tied very specifically to the structure of the token. So it's not unlike reading through a bond covenant agreement or something. You have to look at not only, and that's another reason why the valuation here is so important, but also difficult, is you are not only looking at the strength of the business and the metrics of the business, you are also looking at the actual way in which the token is structured and what it represents.
think one thing to add there that I actually would want to push back on Peter for a little bit.
Sure.
In terms of Binance and FTX, BNB, and FTT tokens, yeah, there's not going to be much of a claim. But in terms of pure governance tokens, we'll use Uniswap as an example because Uniswap Labs has equity behind it. I think you'd actually have a pretty solid claim on the treasury. For the most of these governance tokens, like their main responsibility is to oversee the treasury, oversee some sort of investment in future growth in terms of grants programs. But I think with what you're seeing, like I do think you would have a claim over the treasury. And I don't really think there would be a Chapter 11 bankruptcy anyway. You'd just see Uniswap
there's no
Labs
company.
now.
Yeah.
There's no company. Like you just see Uniswap Labs stop deploying contracts, and Uniswap V3 would continue to work fine. It would just continue to exist as it is and not any future iterations.
Yeah, I mean, you wouldn't see a bankruptcy in something that doesn't have a corporate entity to declare bankruptcy, right? I guess this would be somewhat hypothetical because you would need a corporate entity. You would need Starbucks to have a governance token over, like, what dark roast do we produce this year, and if Starbucks filed for Chapter 11, then like what's that governance token worth? Like probably not a hell of a lot, right? But those, we're so early in the life cycle that those really don't exist at this point in time. So but point very well taken on a decentralized entity. If there was some like unwind, like Nexus Mutual is a good example, right? If there was some sort of unwind there, the governance token holders theoretically have a claim on the Nexus Mutual treasury, and you can evaluate that like you would any insurance company on a price to book value. Well, beautiful. Well, I thought it was a good discussion. I appreciate everyone's attendance and thoughtful questions. Everyone who registered will receive an email with the replay and the presentation as well. And certainly feel free to reach out if you have any other questions or things we can help with. So Katie, Alex, thank you both so much, and we'll see you all again soon.
Thank you, Peter. Thanks, guys.
Take care.